Hello everyone, welcome back to the channel. Today I'm going to talk about a fascinating topic. Can you actually save taxes by becoming an NRI? This sounds too good to be true, right? Well, there's a legal way to do it, but it's not as simple as like buying up a simple flight ticket and flying abroad. So stay with me till the end of the video because I'm going to break it down step by step, the ways how you can save your taxes by being an NRI. Now, the main important question that comes to our mind is like, why are we even discussing this? So this is a hot topic recently because the Income Tax Appellate Tribunal, the ITAT, they gave you a ruling that completely changes the game of many investors. It is said that if you are a resident of a country like Singapore, UAE or Portugal, so basically these are countries that's got like double taxation avoidance agreements, which means DTAA with India. So if you want to know the list of all the countries, do leave your comment below. I'll leave the list of all the countries that gives you a DTAA. And if the treaty has got a residual clause, then your capital gains from Indian mutual funds might not be taxable in India. So imagine that like a scenario where you're investing in Indian mutual funds, making up good profits and paying zero taxes on those gains. It sounds amazing, right? But there are specific conditions or a few hidden risks that you must know about. So in this video, we're going to see like what all the pros and cons of this and how you can make up your savings in this. The first one is like what exactly the law says or how exactly is the governmental rule on this. So let's start with what the law actually says. So under India's DTAs with certain countries, there is a clause called as residual clause. This clause basically gives you the right to capital tax gains to the country where the person resides and not India. So except in the case of shares and immovable properties. So now here is the key part. Mutual funds are not considered as shares. They are technically considered as units because it's issued by a trust. So because of this technicality, if you're a tax resident in Singapore or UAE, then you sell your Indian mutual fund units, your gains are not taxed in India. So that's how it is. So in the famous case that just happened, a Singapore resident investor earned around 88 lakhs from your debt funds and 47 lakhs from equity funds. She declared this in her Indian tax return but claimed an exemption under DTAA, though initially the government rejected it, the Indian tax officer rejected it, but later the tribunal ruled over in her favor. So that's become a huge, and that's now the talk of the town. But wait, it's not so easy. Now, before you start packing your bags to Singapore, let me slow you down a bit. Just shifting to another country doesn't automatically guarantee you that gains, that like you will be like tax-free. So if you fly to Dubai or to Singapore, you're not going to be tax-free. First, you need to be a genuine tax resident of that country. So this usually means that you are spending at least about more than 6 months in that country, at least 183 days to be precise. And only if you are in that calendar year, you will be able to become tax-free resident certificate. You can get this TRC from that country's tax authority, and you must file a Form 10F with your Indian mutual funds to claim that exemption from TDS. So countries like UAE have recently tightened these rules. Now they issue TRCs only for the previous year of stay, not for the future. So you can't just land there and get your TRC immediately and claim your exemption. So the risk of tax avoidance tag, even if you hold everything properly, if you do everything properly, the Indian tax authorities can still challenge you under GAAR, the General Anti-Avoidance Rule. So under your GAAR, it looks like if you have changed your residency only to avoid your taxes, then they can cancel your tax benefits. So if your tax savings from these tricks are more than 3 crores a year, the taxman will definitely scrutinize you. So the Indian department, IT department is not so easy to be like fooled around. So basically you have to prove your genuinity of moving abroad for your work or business or for personal reasons and not for your tax gains. So even after you claim your DTAA benefits, you might still end up fighting up your messy case with your Indian government if you try to play around any mischievous tricks with them. So who can actually benefit from this? So if you wanted to like really move abroad, if you have any plans of that towards your work or your retirement or your business, then it makes your perfect sense to structure your mutual fund investments carefully. So NRIs who are already residing in countries like Singapore, UAE, Mauritius, and Portugal, they can start planning right now to claim these benefits, especially for those who have big investments in debt funds. This is a golden opportunity because debt funds in India are taxed heavily. But if you're thinking about moving abroad only to save your taxes, then you're definitely taking a huge risk. Please do your consultation with your tax consultant first, because this is not going to work out. The Indian tax department will definitely going to send you notices if you're trying to file your taxes according to these laws. You can legally save a lot by becoming an NRI, but only if you do it in the right way and with a genuine residency, proper documentation, and with a clear intent. So I hope you found this video to be really useful. If you liked it, smash that like button and share it with your friends who are planning to move abroad. And don't forget to subscribe for more such financial insights. And I'll see you in the next video. Bonus tip, if you want me to add up your residency certificate as well as your Form 10F step by step, just leave a comment below. I'll add up that into the first comment of this post.